Hello investors, thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about GoodRx. So GoodRx just reported their results Q4 21 last night, and they pretty much talking quite bluntly about the fact that their growth rates are going to decelerate after 2022, and we're looking at after 2022 for it to be growing at in the mid 20s range. So for a business that just came out of 2021 growing at the high end of 30% CAGR, investors are kind of like, whoa, 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 slow down, what's going on here? And everyone is kind of now looking beyond the growth rate and everyone's trying to think, okay, what do the EBITDA margins look like? And management said, okay, don't worry about it because on a rule of 40, we're coming up at 65%. We're going to be, after 2022, we're going to be growing our EBITDA margins to approximately 40%. Everything's going to be all hunky-dory. This puts a stock priced at approximately 21 times this year's EBITDA figures. So I'm going to go through all that. We're going to discuss really what investors need to look at. So yeah, let's just jump right in. So here's the thing, right? Results didn't come out too well for investors. The stock is down approximately 30% after hours, and investors are like, okay, we were kind of in this as shareholders as of a high growth company, and you're pretty much just putting the brakes on and saying, okay, all of a sudden this is no longer a high growth name. This is going to be a business where everyone's should be focusing on our EBITDA margins. So I'm going to come around and circle around this EBITDA profile in a minute, but this is just, when you change the investor base, it's kind of tough. You're going to have to re-educate a whole new bunch of shareholders. So it's kind of like, it's a tough one. Okay, so kind of let's just jump right in here further. So this is the thing that everyone's talking about, right? So the guidance for Q1 is for 25% year-over-year growth rates. It picks up slightly as the year progresses, okay? So two different dynamics here. The first one, which is that the guidance for 25% is not that strong. Okay, you've just exited. I know that there's some seasonality in those two acquisitions that they made in last year's Q1, but you just exited with 39% revenue growth rates, and all of a sudden you're seeing 25% next quarter. I know that it's year over year, and when I'm talking about sequentially, but there's like whoa, what's going on here? The second thing is that they talk about very bluntly on the call that after 2022 they're going to be growing for the foreseeable future at approximately mid-20s, and investors are like, whoa, what's going on here? And like, we were aligned with this, and this is like the story that GoodRx becomes a very viral platform where healthcare providers can just get the needs that they need, like, so they can save a lot of time, administrative burden comes down, you get a lot of healthcare cost savings for patients. That leads to a lot of the medication getting out to the people that need it. Patients are adhering to the medication, and that's all good hunky-dory. But then all of a sudden we're seeing that kind of it's like deceleration. You're like, it's tough. And it's at a tough time because right now, growth names have just been absolutely demolished. And we've seen some of this happening in the last several days. It's very, very interesting because in the last several days, I've seen that, since November, it was all one trade, right? Everyone was just like, irrespective of what was happening, growth names were getting battered. Everything was just getting battered. And in the last several days, I started to see a very slight dissemination of investors. Investors are kind of like, okay, this is high growth, but it actually makes profits. And this is high growth, but profits are like the next part of the story. It's like a second layer of the story. So I think that there's a bit of like the market's kind of looking for direction. I think this is quite an interesting point that we're going to be seeing in the next several days, how things are really starting to unfold. I think it's quite an exciting time to be an investor. I think that everyone's talking to me and saying, is this a good time to invest? I say, well, depends. If your time horizon is 30 days, then it's difficult to know. But if your time horizon is kind of slightly longer than 30 days, I think this is a very exciting time to be investing. Now, so as I already alluded to here, so the street was expecting 40% growth rates for Q1, and they came out with 25%. So it's like a very large discrepancy, and nobody likes bad news. Investors don't want surprises. Investors, particularly right now, and particularly surprises that are this large on the negative side. So it's kind of putting out straight away. So if you get into Q1 and the discrepancy between what analysts expect and what they are guiding for is so large, this puts a question mark on the high end of their guidance for the year. For the year, they pointed towards 33%, and for Q4, they were just at the midpoint, so they weren't even easily beating on the top end. So first they kind of like come in just about the midpoint for Q4, and then there's this large gap for Q1, and it's like, whoa, this is more than a bargain for people are thinking to themselves. So yeah, I already kind of alluded to that. It's an interesting business model, right? It's any time that you're able to, on the one side of your marketplace, let's call it, on the one side you're able to drive network effects by decreasing the amount of time that the providers have to use the platform to drive the healthcare, and on the other side you're driving cost savings down. That gives you a large moat, and that's really what's very attractive about the business model and what got a lot of people aligned to start with. It's a compelling story. So yeah, the business proposition here is very, very strong, and I think that's what's attracted a lot of people to this stock. I know a lot of people that are in this business, this investment. Now, here's the problem, right? So as I look at this, the stock-based compensation is the major driving force of the net cash flow from operations. So that's a bit of a mouthful. I'm just going to rewind that very, very slightly, okay? So the business isn't really making that much cash, ultimately. There is a large portion of that that's stock-based compensation, and when you think about it, that management was getting that stock-based comp, but with the share price at an all-time low, after the after-hours sell-off, they're going to have to issue a lot more shares to compensate for the shares that they did issue that don't have as much value right now. Furthermore, a lot of that stock-based compensation over the next year will have to become a cash expense, because management is saying, okay, I don't want to be paying the stock anymore. Your stock is not worth much. Give me cash. So that's going to be something that's going to be quite interesting for investors to think about as well. Now, I was kind of looking through, and it's quite interesting here. So you can probably pause the video, have a look here. So the top two executives after the IPO got approximately each 260 million in stock-based comp, okay? So as options, So you're looking at a business and they're thinking to themselves, okay, my stock is down more than 50%. So I felt that I had some funny money that was worth like $250 million, and now it might not be worth that much. And the climb from here is going to be really, really high. So I need to be, that kind of causes some kind of psychological dissonance, because you kind of like think to yourself, okay, what's the point of me working so hard? It's not worth what I felt it was worth. And that percolates throughout the team. So when it comes to retain that executive talent, it's kind of like, everyone's kind of despondent, and it just drags the team down. So I think that's going to be an interesting dynamic to think about. The other thing that I want to mention is that let's just take some back of the envelope calculations, okay? Let's say that GoodRx ends up growing its top line by approximately 35% year over year for 2022. They print 1 billion in revenues, okay? So at 1 billion in revenues, that means the EBITDA figure for this year at the high end is 330 million, okay? So that puts the stock priced at approximately 21 times this year's EBITDA figures. Now think about this, right? If you pause the video, you can have a look here. The adjusted EBITDA, approximately 80% comes in the forms of stock-based compensation and interest expense that gets added back. So 80% is just the running cost of the business. You need to pay management, you need to pay the bank, right? So what is actually the EBITDA figure? They talk about, okay, everyone don't worry about it. The EBITDA is going to reach 40% after 2022. But you think to yourself, but what am I as a shareholder actually getting out of this? The other thing that I think is interesting to mention is that if you look at their balance sheet, so they've got 660 million of debt, and they have 940 million of cash. So that means a net cash position of 280. But they talk about having a share repurchase plan of approximately 250 million. So you had, on the one hand, 280 million of net cash, but you're going to deploy that to buy back stock at 250 million. So it's like, I think that's really ill-fated, because it's like, that seems like a really poor capital allocation strategy to look now to repurchase. You need to be investing in that business, driving that that those revenues higher, and they essentially say, okay, we have nowhere really to deploy our capital right now. We might as well just buy back our stock to kind of bolster up our share price. It's going to be tough. It's tough sell to investors, and that's why the stock is down so substantially, right? After all, so just to recap here, everything. So Q4 results were not as strong as everyone wanted them to be. The guidance is not that attractive. It's going to be a story that after 2022, they're going to be growing at approximately mid-20s. It's going to be increasingly an EBITDA story. And I just highlighted for you the EBITDA is not as strong as it may appear to be. So the stock is down significantly, but remember, cheap can always get cheaper. So I'm not going to deploy my own capital here, but if you want to know what stocks I'm buying right now, don't forget to check out my marketplace. It's called Deep Value Returns right there above the screen. And you can find out the names of the stocks that I'm buying. I'm looking at businesses that are very, very attractive with strong free cash flow generation and cheaply valued. Okay, thank you so much. See you soon. Bye-bye.